Hey, Paul.
Hey, Ville. How's life?
Life is good. It's snowing outside properly for the first time, I think, during this winter. So looking forward to seeing if we're going to have a white Christmas.
I hope so.
Yeah, indeed. But I'm almost afraid to ask about this, but we do have to do this for our listeners. Do you have a joke for us, Paul?
Of course I do. Yes?
Oh, I was afraid you're going to say that. Okay, please go ahead.
Okay. So, a local bank here in Finland is introducing a cash point machine built into a tree.
Mm-hmm.
If it's successful, they might expand to other branches.
Oh no! Oh no! Please! What? Okay. So who gave us this fantastic moment in life?
So this joke came to us from David Grundy in Copenhagen. Our good old friend David Grundy, Mr. Danske Bank blockchain.
Yes, indeed. Yeah. He was the guest in season 1, I think, right?
Yeah, he was indeed. Yes.
Yeah. And a good guest he was as well, as are all our guests, of course.
Yes.
But, dear listeners, on with the show and the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies with real-life examples from guests and experts across the board. We scour the world to seek out interesting fintech stories and insights ranging from emerging technologies to game-changing disruptive ideas brought to us by the big banks, technology companies, and fintech startups. All of them seeking to challenge the status quo with revolutionary ideas and big, fantastic dreams. This, as always, is Fintech Daydreaming. Hello and welcome back to the show. My name is still Ville Sointu, and I have the privilege to be the host of today's episode. We have an awesome episode lined up for you today, but before we get to the good stuff, we of course need to say hi to my favorite and only co-host of the show, Paul Krogdahl. How's it going today, Paul?
Still going good, Ville. Still going good.
Still good. So no change in the last minute or so. Perfect.
No.
So we have a bit of news to share, I think. We have a website.
We do indeed, yes. We've got a nice, new, fantastic, beautiful website. A lot of effort put into putting it together. It has, on a running order, the latest 5 podcast episodes available for people to listen to or watch. I mean, remembering we do publish as well onto YouTube. And we would love for people to hop onto YouTube and hit the subscribe button and help us to build up our following on YouTube. That would be fantastic. But check out the website. It is, as expected, on fintechdaydreaming.com.
Excellent. And you will also find our contact information on the website. So please get in touch. If you love the website, get in touch. If you hate the website, please let us know, and we'll see if we can fix it. Either way, you can find the contact information and information about the guests and the hosts from the website, and we're really looking forward to your feedback on the website. But enough of chit chat. Let's get on to the interesting part of the show, because our guest today is Dr. Keir Finlow-Bates, and I couldn't be more excited about having him with us today. Keir is a researcher, an author, and an inventor in the true meaning of the word, but he's also the CEO and founder of Chainfrog and Thinkler. Finnish startups. These Finnish startups are researching and developing blockchain intellectual property. Keir holds an MA and a BA in mathematics and engineering from Cambridge and a PhD in mathematics and education from London. He's been researching blockchain technology for almost a decade, I guess almost over a decade by now, and has dozens of patents granted, and that number is going up on a regular basis as Keir is extremely productive in the intellectual property and patent space. So, Keir, welcome to the show. How are you doing today?
Oh, thank you very much. I'm doing very well.
Great. Are you having snow where you are right now?
No, not at the moment, although it is pretty cold. So,
Okay. Yeah, seems to be a regional phenomenon then, because you are based in Finland, right?
That's right. Yeah, I'm sort of halfway between Tampere and Turku.
All right, all right. And for our international listeners, that is, I would say, maybe 150, 200 kilometers away from where we are with Paul. But anyway, let's get on with the kind of meaty topics of the day. So, Keir, could you tell our listeners a bit more about you and your work?
Yeah, sure. So I spent about 20 years in the software industries, mainly as a test engineer and a test manager, and got interested in inventing because various employers offered remuneration schemes for submitting inventions to them. It was in the last 5 years of working for companies as an employee that I stumbled across Bitcoin. So I think that was early 2010. Unfortunately, I only did things like looking at the code and the protocol. I didn't go out and buy lots of cheap Bitcoins, which is why I still have to work for a living. But then in 2015, there were a lot of layoffs where I was working, and I decided to strike out on my own and become an entrepreneur and focus on blockchain full time. And of course, back in 2015, there's still a lot of skepticism from a lot of people about what the significance of all this stuff was. I think we're seeing now that it does have legs, but back then it did feel like a bit of a gamble. But I like to think it's one that paid off because it's a really, really interesting technology to work in, and draws in so many different things that I'm interested in. So I couldn't be happier.
Yeah, indeed. I think you've spent a lot of time on this, and I guess we share a bit of experience there as well. Because when I first started being interested in Bitcoin, the number one mistake I did was that I actually didn't get any Bitcoin myself. So I also have to work for a living and also make a podcast for a hobby at the same time, which is, by the way, a lot of fun. But yeah, so let's move on with the topics of the day, and because we are a fintech podcast, I guess we need to kind of move on to the kind of financial services and banking space and the application of blockchain technology in that space as well. But blockchain, of course, is a very broad topic and has applications practically anywhere where there's a need to build networks of trust. Yet outside the crazy world of permissionless cryptocurrencies like Bitcoin, we haven't really seen large-scale adoption of blockchain technology happen just quite yet, even though there are some examples out there. Now, if we kind of take a step back a little bit and kind of look at the trajectory of blockchain technology usage in the financial industry, I think this all kind of started, properly started in 2015 when the blockchain, not Bitcoin narrative, got into full gear, along with the rise of Ethereum. Now, those utopian dreams of a fully transparent and decentralized financial infrastructure never really materialized in the way many imagined back then, at least not yet. But we've seen certainly a lot of interesting development in different parts of the value chain, nonetheless. Now, Keir, what's your view on blockchain technology usage in financial industry? Is it a solution looking for a problem or something else?
Well, I think first I have to start off by pointing out that I don't work in the financial industries. I've never worked for a bank. So I actually have no idea what is going on inside their offices when they're working on these things. However, as an outsider, I can observe from news reports and stuff how things change over time. And I do some consultancy for a Finnish company called Ville Chain Analytics, who are looking at helping the financial services be able to track transactions on blockchains such as Bitcoin. And I think my first take would be that the financial industries are heavily regulated, and for a reason. And as a result, they are not agile startups that can just run with a wild idea and see where it goes. If you're managing millions or billions in client portfolios, you're not going to have a good reputation in the industry if you just pivot at a moment's notice from how you do things from one paradigm to another. And when you look at blockchain, it is a paradigm shift. It's a different way of looking at how transactions at a fundamental level are handled. So in that respect, I'm not at all surprised that we're not seeing banks put up big billboards saying to their customers, hey, we're using blockchain now. In fact, if anything, I'm surprised to see how much is actually going on. If you look at, for example, the patents that have been awarded and the patent applications that have been filed that are now publicly available, you'll see that companies or banks like Bank of America and MasterCard, PayPal, have been quite busy filing away. So it's not like they've ignored it. It's just that they haven't seen it necessary to make big announcements about it yet. Does that make sense to you?
Yeah, it does. I mean, one of the things that we have talked about in the podcast before, and an example that I tend to bring up when we talk about blockchain adoption, for example, with my employer, is that, as you correctly pointed out, the banks do not put these big billboards outside saying that now running on a blockchain. It's mostly about finding the efficiencies in creating these networks of trust, and sometimes blockchain does bring some unique features into this network building that can be utilized. But ultimately, from a bank perspective and the bank's customers' perspective, the banks tend to hide the technology that is behind these new and interesting services. So to me, it's about the being able to create this new type of trust between institutions and our customers by using blockchain-like architectures. And indeed, it should be invisible to the customer. But I mean, one of the things that I oftentimes run into when having these conversations about blockchains and banks is that the banks and the financial industry in general has built these kind of trust-based networks for decades, even before blockchain technology came along. I kind of briefly mentioned already that blockchain has some unique characteristics that could be interesting in terms of building more efficient infrastructure. But what do you think are these unique features that might make this blockchain technology relevant in building these next generation trust networks?
I would say it comes from the perspective of the customers or the users of the bank, rather than from the bank's perspective. And I think that's ultimately where the pressure is going to come from. And one of the reasons that we're not seeing change yet is that pressure hasn't arrived, because people are still coming to grips with what all these things mean. So when I think of it myself personally, one of the things that I like very much about open permissionless blockchains is that I am truly the captain of my own ship. I truly own the cryptocurrency or the tokens that I have acquired in a real sense. Whereas when I have money with a bank, they are the custodians of it. And I have to effectively make a request to them to be able to spend what is meant to be my own money. And that kind of system works fine if everything's running smoothly, until, for example, just the other weekend, there was a 2-day service interruption and I couldn't withdraw any cash from the cash machine, so I couldn't pay my kids' pocket money, and I couldn't make purchases at the supermarket with my Finnish bank card. I had to switch to using my English credit card in order to be able to buy groceries. And so as traditional bank customers, we kind of accept that that's the way things are. In the same way that my grandparents accepted that they had to go to the butchers and the bakers and the grocers whenever they went shopping. There wasn't a convenience of a supermarket. But people over time expect higher and higher standards of service. And I have a story about when I was at my cottage in the middle of the Finnish forest in the middle of Christmas, and there was a power cut, and all the power networks went down. But the funny thing was that I had my mobile phone and the cell towers had battery backup. And so it turned out that although I couldn't boil a pan of water to make a pot of soup, and I certainly couldn't use my desktop to go and use PayPal or something like that. The fact is, I had a wallet on my phone, and the cryptocurrency networks don't go down because they're so decentralized. So despite the fact that I was in candlelight, in effectively sort of pre-industrial environment, I could have, if I wanted to, transferred cryptocurrency to somebody else on the other side of the world. So that kind of thing, I don't think traditional financial infrastructure offers yet. And that would be an example of something that blockchain could potentially offer. So that's just one example.
Yeah, it's an interesting point. However, I sometimes feel when talking about this, basically my keys, my Bitcoin, not my keys, not my Bitcoin type of conversations, is that most people who want to interact with Bitcoin don't really understand these nuances of this of things that you need to do in order to really be in control of your own assets and so forth. And that, of course, leaves a lot of room for different kind of fraudulent activities around the network, even though the permissionless blockchain networks like Bitcoin might be transparent and fair and allow you to really own your own coins for sure. But it's really about the services around it that try to make it simple, but also then expose a lot of customers for potential fraud. So what do you think about this this gap, this kind of technology gap that users need to kind of cross before understanding the true benefits of this technology?
Well, I agree entirely with you that for your average person in the street, they don't want to have to mess around with effectively tuning the engine of the system or understanding all the moving parts inside it. And whereas, for example, if you have bigger institutional players, they might be more concerned about actually having more control over what it is that they have. And there will always be custodians, there will always be services offered, and it would be better for ordinary people if they were offered by known, trusted financial service providers rather than some random website that they found on the internet one day. So I agree entirely there that the usability of the system needs to be improved, and it needs these big, well-known players to actually adopt it before it really will go mainstream, in my opinion. But it does offer a platform for those institutions to build on. And now that you see, for example, more and more companies putting spare funds into some of these cryptocurrencies, I imagine that the financial services will recognize there is now a market there in a way that there wasn't 5 years ago. And we will see improvements in that area. It's purely a matter of customer demand. And banks are not interested in catering to a small handful of radical libertarians. It's not a big market to target. But they are interested in providing services to large companies sitting on large cash reserves that they're not doing anything with. So I think purely from a business perspective, over time, it'll just make more and more sense.
I think there's maybe also a difference between regulated industries and non-regulated entities, right? And I think that the banks, although sometimes maybe want to do certain things, they are bound by laws and they're bound by the regulators. But that also gives a certain element of security and trust to the general population, right? Another big difference between Bitcoin or any other cryptocurrency versus your money in the bank is the fact that the money that's in the bank, it is backed, it is insured. The bank can't just theoretically take your money and run away with it. Whereas, if your crypto wallet is hacked, it's hacked. No one's going to come along and say, well, that's okay, it was insured and we can help you. Whereas if your credit card is copied, then there is certain limitations that the bank will stand behind to actually help you out and to refund you to a certain level, right?
Yeah. And, we have all these financial regulations for a good reason. I spent about a week reading all the recent 2019 FATF regulations on virtual assets. And it's very long and it's very tedious, but it's there for a reason. I think the insurance that is offered by these central authorities effectively is something worth looking at in further detail, in that it is good that it is there. What is FDIC insured, I think is the American term.
Yes.
However, that still means that it doesn't mean that there aren't people who fall through the cracks. There was a report about 9 months ago of a client of Barclays, I think, who accidentally sent a large sum of money to the wrong bank account that unfortunately had the same name of the person he was sending it to. And it was really only when the newspapers, I think it was The Guardian, got involved that Barclays finally pulled their finger out and actually got him his money back. It's a known problem in cryptocurrency that you can send your money to the wrong address due to a typo, and it's just gone. So there need to be more and more safeguards in place in order to prevent that kind of thing happening. But no matter how many safeguards you have, there's no guarantee, and we see it in traditional finance as well. However, the regulations are there for a reason, and they are something that I support. Now that there is finally some guidance, and that is a big step. The fact that the FATF have actually put out guidance, and the EU is bringing in directives in order to indicate to the various European countries how they're to implement it. These are very significant because now it finally means that banks who are on a bound to follow these regulations actually feel that they have some kind of a foothold and some kind of understanding of where they can start. And that was another big problem 3 or 4 years ago, was that they weren't going to touch it because they had no idea what was going to come along in a few years' time, and that all that work could be undone. So I see all these things as very positive moves.
Yeah, and I suppose we could say that the banking industry is quite rapidly heading in that direction when we start looking at central bank digital currencies.
Mm-hmm.
Right? It is it's a fine line between the cryptocurrencies into the central bank digital currencies. They're both based on the same technologies, but coming from a different regulated standpoint, right?
Mm.
Yeah, and it's central banks by definition, of course, are centralized. So there's a kind of a dilemma there on how do you actually do it? Can you do it decentralized? And if you look at the models of the European Central Bank, for example, is doing right now, it is just a fully centralized accounting system rather than a cryptocurrency. But in terms of regulation, there's an interesting part of regulation that's coming down the line now, markets in crypto assets, MiCA regulation. It's in the same vein as the MiFID regulation, which is for securities in general. But the markets in crypto assets regulation from the European Union is up for review right now, and that's definitely worth having a look if you're interested in crypto regulation and how it's going to look like in the European Union.
Well, I try to only read it if I have to be honest, because it's not the most exciting material to wade through. There is one thing I wanted to go back to on there, though, which is that you're right that at the moment the European Central Bank is looking at digital currencies they're just digital currencies. It's not a decentralized blockchain-based system that they're proposing at all. However, of course, money, cash, which is on the way out, is decentralized. Once it's out there in the economy, the banks no longer have any control over it. They can't magic a £5 note or a €10 note out of my wallet. And although cards and mobile pay are convenient, I think that as it gets harder and harder to find cash, there are going to be ordinary people who, I hasten to add, are not criminals, who find that it's actually rather, there are certain circumstances where you just need cash. You need to have this effectively a bearer bond or some kind of asset that is under your control. So I can't help wondering if we're going sort of through a wave where we're moving more and more towards centralized financial systems where you are not in full control of them, that as we lose our decentralized system, traditional money, more and more awareness of what we've lost will arise, and that eventually that could see us move on to, at the end of that wave, moving back to a decentralized form of a digital currency, or of a currency, but then digital rather than physical. But it's just a thought.
I think that's sort of connected to the issue of the large number of unbanked people we have in various societies, right? As long as you still have unbanked people, you still have a need for some form of transfer of value, whether that is form of cash or cryptocurrencies maybe, right? But having cryptocurrencies also means that you need to have access to technology, which most people these days do have a mobile phone, but there are still certain people who don't. And therefore the cash still has a place in society, right?
Yeah, well, if you look at situations where there is no money available, people invent it. So you've all heard stories about prisoners using cigarettes as a form of currency because they didn't have money in there. And I think you'd find the same thing would rapidly happen in general society. If there was no cash available at all, people would turn to something else because there are just occasionally needs where you need to engage in a financial transaction, and doing it in a digital or a computer-backed way isn't possible, like, as you said, the unbanked.
We sometimes ask our guests actually to share their favorite technology-related war stories. You had a great example there about being able to still use your phone, even though, the power and everything had gone out. But, great stories give interesting color to topics we're discussing here on a regular basis. With your incredible amount of experience, you must have a lot of great stories of your own that you could spend, a couple of minutes sharing with our listeners.
Well, yeah, I was thinking about that the other day, actually. There's lots of little anecdotes and things like that, but I think I'll talk about the early days of ChainFrog, where we had this product called Blockbinder. And the idea of it was that it would connect a blockchain to a traditional database, because at that point, there were very few people who knew how to write code to work with blockchains, and they weren't very well documented, but there were lots and lots of database developers out there. So we thought, this is fantastic. We've got a great market here. As it happens, we didn't get market traction because the market hadn't got there yet. But we'd spent about 6 months coding this up. And then one day my CTO called me up and said, I've been working on this for half a year. And why are we interfacing a database with a blockchain when we could just do this with a database? And he was really, really dejected. He felt like he'd just wasted 6 months of his life on something, and then had this sudden realization that, hang on, I've been all swept up in the beauty of this technology and how interesting and complicated it is and how it draws in cryptography and maths, things that he loved. And then I think he'd woken up at 3 a.m. in a cold sweat thinking, but you can just do this with a database. And of course, technically speaking, he's absolutely right. The technical side of what a blockchain does can be done much more efficiently with a database. And I had to explain to him that, you're looking at this as a technologist. We're not solving a technology problem here. We're solving a social and a psychological problem. If you can get everybody in the world to agree, then you don't need to have a government. If you can get everybody in a consortium of companies to agree, then you don't need a blockchain. But the fact is that when you look at how any group of people bigger than 3, I would say, getting consensus is really, really hard. And any methods that can improve the speed at which consensus is obtained and that can help ratify and lock down decisions is going to have long-term benefits. And it's not a technical problem. It's a problem with the human mind. And blockchain solves that. And after I'd sort of given him the 15-minute pep talk, as you're duty bound as a CEO, he just breathed a big sigh of relief and said, thanks very much, and had the most productive week of coding after that. So there's one anecdote for you.
Yeah, that story sounds so familiar. There's a lot of people who got swept away in the blockchain hype, and then suddenly realized that most of the things that people have been working on can really be solved with a database in a much easier way. But then there is the kind of small amount of cases out of everything that was done that actually requires this decentralization element in order to keep it transparent and fair. And I think it's about finding those correct applications of this technology that will allow this to move forward as well. But Keir, we're kind of spending a lot of good minutes here talking, but I need to move us forward in the kind of the questions that we have here. And one of these questions is that while I was doing pre-work for this episode, I actually stumbled upon an interview of you from 2019, where you said that your view on blockchain technology shifts monthly. So now it's November 2020, the last time I checked. So has your opinion changed in the past months? And if so, how?
Honestly, it does all the time. In fact, it's been a bit of a problem with writing my book, and I'll now show that on camera here. I've got a book coming out at the end of the week called Move Over Brokers, Here Comes the Blockchain. And it's a collection of the thoughts that I've had over the last couple of years. And just in discussing this book on LinkedIn with people, the question of what does it mean to own a token on a blockchain? What does it mean to own a token on a blockchain? And I sort of realized that although you own your token, it's not the kind of ownership in the same way as owning a picture on the wall or owning a car or a piece of land. When you start looking at it from a legal perspective, and that there's one peculiar thing about, for example, owning a Bitcoin is that you can just abandon it. You can just put out the public key to your coin and say, here, anybody who wants it can take it. And that's not actually a transaction anymore. If you sell me something and I pay you with cryptocurrency, I actually actively issue a command to send a transaction to the network, and that transfers the ownership of the coin from me to you, and it's my decision. I guess the closest thing would be if you just sort of left your car on the street with the keys in it and said, anybody who sees this can take it. It's strange that you can do that with an asset, and anybody in the world can take it. I can't think of anything else that you can do that kind of thing with. So we're sort of realizing there's an extra depth in ownership that, if I put a £10 note on a gatepost, only people who are walking past, who are actually in a physical location, can claim it. If you look at intellectual property, if I own a patent, I can't just put it out there and say the first person who wants to take it can take it. There would have to be a transaction where I actually sign the ownership over to that other person. But with a decentralized blockchain system, you can have ownership that you can effectively disavow. And so blockchain is just full of these little subtle things. And I'm a big fan of analogies, of finding things in the real world that allow you to get a better understanding of how blockchain works. The problem is that although the analogies are sort of 95% effective, that remaining 5% can often be really subtle and really give you a different, almost philosophical perspective on what's going on. So yes, it's still changing.
Yeah, I think it's interesting to see how this narrative changes from experts like you, and of course how the population ultimately will kind of understand, the broader population will understand these analogies and the application of this technology. One kind of thing that occurred to me when we were talking about the when you send your cryptocurrency, then it's gone and you can't get it back because it's a decentralized permissionless system. One interesting kind of technical thing that occurred to me is that because of this nature that you send the crypto and it's gone, in Ethereum, the address wallet address 0, which is not owned by anybody at the moment, is actually, there's millions of Ether locked in that address because when people program these quote unquote smart contracts on Ethereum, typically when they have a bug, they send Ether to address 0. So there's a lot of kind of dead crypto in that address. But yeah, there's a lot of these stories that we could kind of go over on hours and hours. But unfortunately, as always, time flies when you're having fun, and it's almost time to close another episode of Fintech Daydreaming. But before we close, though, it's time for our traditional end segment, which I'm going to start calling Same but Different from here on out, by the way. We usually want to talk about topics that are a step or two removed from the main topic of the day, but more often than not, we actually end up where we started anyway. And just in this, keeping this theme alive, of course, today's news article we picked is yet another decentralized finance scandal as covered by CoinDesk. So the headline goes, DeFi protocol Pickle Finance token loses almost half of its value after $19.7 million hack. And I think this is a great piece of news for a couple of reasons. Number one, it's just fantastic when Pickle Finance gets into a bit of a pickle when it lost half of its assets to hackers. The assets were actually valued in cryptocurrency called DAI, D-A-I. And for our listeners who haven't heard of DAI before, it is a so-called stable cryptocurrency that aims to maintain its value pegged to the US dollar. So that's why we are able to say that it's a $19.7 million hack. Now, Pickle Finance, the brilliant punchline of the news article, on the other hand, is a DeFi protocol on Ethereum, as we discussed just now, and it allows users to invest crypto and gain interest on their crypto over time. The hackers found a vulnerability in this automated protocol that allowed them to drain one of their so-called jars empty of cryptocurrency. And yes, indeed, a jar is another fun pun in this space. But yeah, what do you think, guys? Will these DeFi hacks ever end?
Probably not. It's impossible to make software bug-proof, and the ways that people can manipulate protocols and software are immense, and there are a lot of eyes looking at this stuff because there's a lot of value locked up in it. But there is one thing that I always find a bit confusing, which is you have this system that talks about smart contracts and everything is written in code and it's all automated. And then you read about a hacker, and the term is used in a pejorative way, draining funds. I mean, a common way in DeFi is something called using flash loans, where there's a small arbitrage, and flash loans from something like the Aave platform allow you to borrow literally tens or hundreds of millions for one transaction, conduct a series of activities, and then pay the loan back. And the loan is only issued if it gets paid back at the end of the same chain of transactions that are bundled in one transaction. So it's an incredible leveraging tool for DeFi traders. And when one of these attacks, as they're called, happens, if you look at the code that is actually being run, they're following the rules. It turns out, though, that they are following the letter of the rules and not the spirit of the rules. When a protocol is launched and a service is offered, there's an idea that it's supposed to provide a particular service, and it may be documented in a white paper, and then that's coded up. But of course, what is actually on Ethereum is the implementation of the white paper. And anybody who works in software development knows that what you actually ship and what the specification says can never be 100% identical. It just happens to be in DeFi that when there's a discrepancy, it can result in tens of millions of dollars worth of cryptocurrency being drained off. In my book, I draw a comparison with George Soros when when Britain had to leave the European, the ERM, because George Soros was exploiting a bug in the British government's thinking. Britain was paying and paying and paying to keep the pound pegged to the, it was EQ then, I think, not the euros, but effectively to the German mark. And Soros recognized they could keep doing that forever. So he just kept piling his funds in, knowing exactly the point at which the British government were going to have to give up. So he exploited a bug in British economic thinking, and we don't call him a hacker who attacked the British financial system. He's generally called a financial genius. So I'm not condoning what these DeFi hackers do, because it's causing a lot of investors who don't know what they're getting into a lot of pain. But it's very easy to start saying that's a hack. I think it needs a little bit more thought in each case. And of course, you're not going to get that from a 300-word news article, unfortunately. But I'm just putting that out there as a thought for you.
Interesting point. So what about you, Paul? What did you think about this?
I think absolutely not. Like Keir said, we are going to see more hacks like this, whether we want to call them hacks or not. I think turning the coin on its head, there are sometimes benefits in activities like this happening, because it makes us, stand up, take notice, and improve the security, improve the code, improve the way that we are doing things. Quite to what you were saying just there, Keir, that they're not actually hacking; they're just following the letter to or the rules to its letters, right? Maybe we need to think a little bit more before we specify how things should run before we make them available, right?
Mm-hmm. Yeah. And obviously, if somebody uses some social engineering to get hold of a private key and drains a contract of funds, that is a hack. But it starts going into a gray area when you're actually running the code as it was put out there on the network. And these lessons are turning out to be very expensive. I mean, the DAO hack being the first big one that we noticed that caused the rollback of Ethereum and resulted in the Ethereum Classic, Ethereum, whatever. It never really picked up a different name, did it? The other one. No. The one that Vitalik Buterin supports anyway. That was an expensive lesson. These are incredibly expensive lessons. But then again, it's finance. You're not talking peanuts anymore. That's
right. I think the kind of code is law camp is looking at the code of the smart contracts, and that if there's a bug, then that bug is also law according to them, which is what we're kind of saying here. Whereas the other camp is saying that no, it's actually the white paper and the intent that is the law instead of the actual code. And it's interesting to see how this will kind of balance out in the future. But at least, as that happens, we will find a lot of these interesting stories to talk about for sure. I am also certain that this will not be the biggest and definitely not the last DeFi hack we're going to see. But awesome stuff, guys, as always. But unfortunately, our time is up. Now, Keir, Paul and I would like to give you a chance to let the listeners know how can they find you, get in touch, and most importantly, how can they find your book?
Mm-hmm. So the best place to find me is on LinkedIn, and my name is unique in the world, so you can just search for it, or my profile is Keir F. And the book has its own website, so I'll just hold that up again to draw attention to it. It's at www.thinklayer.com, and there's even a calendar there with a countdown to the actual launch hour. So that's fantastic. I think it's 4 days and 2 hours away, thereabouts. So do go and check that out, and
perfect.
Hopefully whoever gets a copy will be happy with what they get to read.
Looking forward to that as well. So thank you again for coming on the show and sharing some great experiences and insights with us here today. But most importantly, thank you, our dear listeners, for hanging out with us for another episode. Now, do you have a fintech subject you would like Paul and I to cover in a future episode? Or maybe you have a great story to share and would like to actually join us as a guest? Or if you simply came up with a worse or better banking joke that you heard in the beginning, please let us know, and we'll see whether our listeners will love it or hate it or love to hate it. Now, send us an email on any of the above topics to hello@fintechdaydreaming.com or ping us on LinkedIn, Twitter, YouTube, or the anchor.fm page and get in touch. And do remember that we also now have a fantastic website at fintechdaydreaming.com. Now, Paul and I will be back in 2 weeks' time with a new guest, so see you all again then. This has been Fintech Daydreaming.